Over the last 2 to 3 years, I've been telling people that I expect to see a big house price crash in London over the next few years. And I've said that the crash would start off slowly and then would accelerate and would take a number of years. So, in this video, I'm going to make the prediction that house prices in Greater London will crash by 40% by the end of 2023. And by this, I mean they will crash 40% in accordance to wages. So the price to wages ratio will fall by 40%. Now, this prediction of mine has been met with unbelief, with rejection, with denial, and sometimes with mockery. There have been people who just laugh off my suggestion that there could even be anything such as a house price crash. So, for that reason, I decided to make the video to explain my views and to put it on record so that we can see if I was wrong or right when that time comes. This is a subject that's not easy to talk about. A lot of people have the view that house prices will never go down, and some of those that I've spoken to said that maybe Brexit would cause a lowering of confidence, and therefore there'll be a dip, maybe a 2% dip, a 1% dip in house prices, but they won't crash. I remember one person saying it will never get to 20%, and here I am saying it will get to a 40% crash. In fact, if you look at the price forecasts made by the experts, you will find that none of them really, except for maybe one, Henry Pryor, who does think that the market will see a downturn, a big downturn possibly. The other experts, they may be estate agents, admittedly, predict that there won't be a crash. Knight Frank, for example, is an estate agent, and it's put forward a prediction that by 2022, house prices will increase by 13.1% in London. Savills has a prediction that house prices will grow by 7.1% by the end of 2022. However, there are some experts who do say that things may flatline for a while and then go up by 1 or 2%. The small numbers, but not really big numbers. Although put together, they probably do come up to something like 7% if it's a 2% increase every year for 3 or 4 years. Recently, I was listening to an interview of the wealth advisor J.L. Collins on the Lectures at Google, Talks at Google, channel on YouTube. And he said that on his blog, he wrote an article where he explained why buying a house is a bad investment. He favors other things. He favors buying stocks and especially buying an index instead of picking certain stocks on your own. And he gives a number of reasons for this. He says that houses are poor investments because of things such as they are illiquid. It's not easy to buy and sell a house, unlike a stock or a commodity such as gold or a currency, as an example. He says that you have to maintain the house, you have to look after it. And he's given quite a long list on this blog post, and I won't go through it. But he says that when he published this post, there were a lot of angry people who disliked what he said. There were some who agreed with him and some who pretty much hated what he said. And he was saying in this interview that you could go to a major city in America, stand on a box, and abuse one of the great religious leaders of the past, like Jesus, for example. And you'd get away with it in that people would just ignore you if you viciously abused these people. He said, however, if you put forward the suggestion that houses are not the perfect investment, they would start to gather stones to throw them at you. So he says that this is how passionately some people believe in this form of investment. I have personally come across similar strong views. I think I've met only one person who was quite well read in the subject who said to me that house prices in London cannot rise any more than they have done because they simply are too expensive. Most other people just thought prices will keep going up. Now, why is this the case? Without going into it in too much depth, because it's not the subject of this recording, I think it's because people have seen house prices go up continuously over the last few years, over the last couple of decades, in fact. People can't remember, and I have to admit, I was way too young to remember the house price crash in the mid 90s, which was caused by high interest rates. So people think house prices will always go up. And I think people have invested money into houses, and so there's maybe some cognitive dissonance in not wanting to lose out, not wanting to believe that they could lose money. And I think there are some people who even thought house prices would fall and they refrained from buying houses only to regret it later. However, what people don't know is that in 2008, house prices should have crashed, but they didn't crash because of quantitative easing, whereby the government created money, gave it to the big banks, and reduced interest rates to the lowest point that we've known of, at least from what I know, the lowest point in modern history anyway. I don't know if it's the lowest point ever. And this encouraged people to buy, to borrow more and buy houses. So interest rates were very low. And of course, there is this national obsession. It's maybe it's almost religious in its nature, in that people believe this is what you should do, put your money in houses. And the ordinary person doesn't necessarily buy stocks, they don't buy shares, they don't buy cryptocurrency, although they should do. That's my view. So, housing seems to be the one investment that people know of. However, I believe there is a lack of knowledge here. It's almost as if someone sees their child. Imagine if someone was isolated from a young age on an island. A group of people were isolated, children were isolated on an island, and as they grew, they realized that they kept getting taller. And from that, they came to the conclusion that we're going to grow taller forever, for the rest of eternity, without knowing that you'll come to a certain age and then you will stop. So they didn't have that knowledge. They didn't know that things could stop. And the same happens with house prices, I think. People don't, for example, look at what happened in Japan. There was a massive housing bubble there and a big crash after that, which lasted over a decade. I think it's around 15 years, a 15-year bear market. And when I tell people about Japan, they say, well, London's not Japan. But then again, Japan doesn't have a lot of space. Tokyo, this is where the crash occurred, is a heavily populated city, just like London is. So the argument that people put forward here in London is that the demand is greater than the supply. There's overpopulation, there are too many people, too few houses, therefore house prices will always go up and they will continue to go up. To the extent that I said, well, there'll come a point, I said to someone, there'll come a point when people won't be able to afford them. Ordinary people won't. And they said, well, then people will be homeless. Prices will continue to go up, and those who can't afford them will end up on the streets. I said, en masse. They said, yes, that's what will happen. So if it can happen in Japan, why can't it happen here? I think there is a lack of knowledge, not having witnessed crashes in the past, not observing crashes in other asset markets. And I also think there's a problem with not wanting to get into the detail. When you talk to people, when you have an everyday conversation about a subject, it's sometimes oversimplified. You can't really get into the geeky, detailed stuff. And I'm not claiming I know a lot of this stuff. I just studied whatever I did over the past few years and came to this conclusion. So there's also a problem with trying to explain this to people who might not want to hear all the detail or are not used to it. Because when you get into it, you get a look of not knowing what to say, silence. You say something they haven't heard of, and it's silence. And that can happen in many other subject areas. I'm sure those of you who try to talk about things that contain some detail, some technicalities, try to discuss philosophy with people and see what happens. And you'll see you'll get this blank look from them. Anyhow, so why do I think house prices will crash? Well, I've got 10 reasons, 10 fundamental reasons. And I think along with them, there's always market psychology, the market sentiment. So I'm going to talk about market sentiment first, and then I'll talk about the 10 reasons. But first, let me point out what those 10 reasons are in brief. Number one is that house prices cost too much, therefore they can't go up. So even if they won't crash, they're still not a great investment because they won't go up anymore. Number two, interest rates will go up, causing house prices to go down. Number three, there is social and political pressure to bring down house prices or to make them more affordable. Number four, the extreme state of the economy, very low interest rates, high amount of debt, and that could cause things to tip. It's like where the balloon has expanded too much, or you're walking on the edge of a cliff. Number five, more houses are being built, so there's more supply. Number six, a lack of confidence because of Brexit. Number seven, from Brexit, foreigners will leave, so there'll be less demand, more houses available. Number eight, buy to let investors or buy to let buyers will no longer get tax relief. Their tax relief has been reduced over the years, and it will disappear by 2020. Their tax relief, the mortgage interest tax relief, that is. Number nine, help to buy time bomb. I'll explain that when we get to it. And number 10, I think the money will go into cryptocurrencies. For those of you who don't want to listen to the rest of this, there are the 10 points. But with all of that, there is the market psychology. Let's say house prices do start to fall, and they have started to fall in Greater London. In the rest of the country, I think that house prices are still rising faster in some parts more than others. But in London, house prices have started to fall, and it will get faster. Why will that be? Well, whenever there's a drop in price in any such market, there will be some clever investors who will see what's coming, and they will know it's time to sell. When they sell, it doesn't matter if others haven't sold, prices go down because the price of any asset depends upon the price of the last sale or the last sales. So when people see that prices are going down, some people will get scared and they will start to sell as well. And there'll be those who will see that since prices are not going up anymore, let's say they don't go down, prices are not going up, you will get these investors who will say, well, what's the point of me putting my money in this house when it's not increasing in price and I can put it elsewhere? So they'll take the money out and they'll sell. But you will get those people who own houses and they have a mortgage, and if the price of the house goes down, there'll be negative equity, meaning that the amount that they owe to the bank is more than what the cost of the house is. And they'll say to themselves, and these might not be investors, they might just be people who want to live in a house. They'll sell the house because they'll think to themselves, well, we can buy a cheaper house elsewhere and save money over the next 20, 30, or 40 years. Default on this house, let the bank have it. We won't pay the rest of it. We won't pay the rest of the mortgage. By the way, that's not illegal. It happened in 2008. Some people did this. And that drives the price down further. See, what happens is here we have a cascade effect. When the price of an asset starts to go down, others react and they panic. They might think to themselves, well, this could go on for a long time. Or if it goes down 10% or 20%, we're still going to do it. We're still going to sell. And sometimes it can take people by surprise how low the prices can go just due to market psychology. See, house prices have been going up because people see prices are going up. So let me buy. Let me wait a little bit. Let me wait a few months. Prices are still going up. I'll say, well, now I must buy. I missed out. I made a mistake. The opposite can happen. When there's a bubble, prices overshoot. They go way above what the value of the asset is. And when there's a burst in the bubble, they can fall to extreme levels. So people go to extremes. And this is what will happen. We'll get people who will just get scared, who will not want to lose out on their investment, and they will sell. There'll be forced sellers who will not necessarily be investors, but they'll be negative equity. And of course, there'll be some people who'll be forced sellers because interest rates may go up. They've been at a historical low. If interest rates go up, that means people will not be able to afford their mortgage and they will be forced to sell. And that will be the biggest cause of a big house price crash. I've heard people say that if there's a dip in house prices, we just won't sell. We'll just hold until house prices go back up. Well, they don't realize that there are forced sellers, people who sell because of death, of divorce, of moving to another country, and there's a necessity. So you might not sell, someone else would sell. So let's look at some of these fundamentals that I mentioned. Point one is that houses cost too much. If you've done the research and seen how much people spend on houses, house prices cannot go up anymore. And that's why they've stopped going up in London and started to fall, even though it has been a small fall. I think it will accelerate. And since house prices are not going up, as I said earlier, it's no longer an attractive investment. And if it's not an attractive investment, then all those investors, all those foreign buyers, all those buy to let buyers, anyone else who's got multiple houses will not buy anymore because they'll see, well, people can't afford houses anymore. So, at the very best, what would happen is houses would plateau and flatline and stay flat, flat in accordance, in comparison to wages. But it doesn't work like that because as soon as it flatlines, people say, it's not worth me holding this. It costs money to maintain it. Let's sell it. So that's point number one. Houses cost way too much. Go and look at the statistics. Go and look at the government website on statistics. That is the ONS website, the Office for National Statistics website. See how much money people are putting into rent and into mortgages. It's it's something that's at the very limits. It can't increase anymore. The only way it will increase is if there's inflation. And if there's inflation, well, you might as well put your money into an asset which goes up greater than inflation because house prices can't, because the ordinary person can't afford it. Point number two is interest rates. Now, there's nothing that will cause a big crash more than this. I think even if interest rates don't go up a lot, house prices will still go down. Look at Tokyo. But if interest rates do go up a lot, we'll see a huge crash. And that is, even if a mortgage doesn't become more affordable, house prices will still go down in value. Think about it. If in Greater London you pay £600,000 for a 3 bedroom house, and the overall cost after 20 or 30 years is £750,000 because you have to pay interest back to the bank. You borrow, let's say, £500,000 from the bank, and then you have to pay interest back to the bank. The total cost of your house will not be the £600,000 that was the asking price. The total cost of your house over the 30 years is £750,000. Now, if banks increase the interest rate, you would still be expected to pay that £750,000. However, the price of the house would have to go down to match that £750,000. So if interest rates go up, house prices must fall. Affordability is still the same. You still end up paying the same amount. However, if you have cash and you're not looking to get a mortgage, then you're lucky in that case if interest rates go up. If you've got £250,000 cash, you could buy a house. If you don't, you'll still end up paying the same amount of money. But it's not as simple as that. I think how even the total cost will also go down. I don't think it's as simple as whatever rate the interest goes up by, you will see house prices matching that increase in terms of the fall. I don't think it'd be as simple as that. But my point is, people do not realize the potential of bringing down house prices caused by interest rates. Interest rates are extremely low just now. They're at 0.5%. And before the financial crisis, I believe they were about 5%. And in the mid-90s, they got to about 15%. And that can happen if certain factors come into. So the question is, what could cause interest rates to rise? Well, the Bank of England did increase interest rates because it did fear inflation. Inflation caused by the weakening of the pound after Brexit, and that caused the base interest rate to increase by 0.25% from 0.25 to 0.05 not so long ago. And if this continues, if the pound continues to weaken, and there's a fear of inflation, to make the pound stronger, just to make the pound stronger, in fact, the interest rates could increase. And considering how much at an edge people are in terms of debt, how risky people's positions are, increasing interest rates will cause many defaults to occur. So it can happen if the pound decreases in value because of Brexit. It can happen for other reasons. It can be purely psychological because the bankers are not used to such low interest rates. They feel uncomfortable. Many economists feel uncomfortable with these levels. So they might just perhaps make a mistake and increase rates because they think they've been too low. And you see some central banks wanting, the Federal Reserve in America, wanting to increase interest rates because they think that it might cause problems with greater inflation. Donald Trump has cut taxes for the rich in America, and that could increase inflation. More money is available for people, and therefore, and even if it's not, people might just anticipate that happening and they will increase interest rates. However, there's one thing which I think will be the main factor here, and that is the the interest rate of the US treasuries. So the government bonds in America, they have an interest rate. So if you buy government bonds, it means that you are lending the government money, and then the government pays you interest back. And this interest rate has been at historical lows. It's from about 1980 until now, the interest rate, the yield rate of the 10-year US Treasury has been decreasing. So it's been falling all the way down. But of course, for those of you who know, the price of the bond itself has been increasing because they work in inverse, and I won't go into what that means. So we have started to see a reversal, and again, it could be purely psychological because people think, well, this has been falling for how long? Over 30, 35 years. So maybe it's gotten to the bottom now, and maybe yields need to go up. So it could be purely psychological in that they think there's a reversal needed. It could be because they expect the economy to heat up, they expect there to be inflation. Maybe they're anticipating the Fed to increase interest rates. So we're seeing this rate of the US Treasury increasing. Now, if this happens, oh, and there's another reason. The government in America are in a deficit. They need to borrow money, and Donald Trump reducing taxes has made it harder for the government to obtain money through taxes. Therefore, the government needs to get money somehow. And the way they get that money is by selling bonds. And to entice people to buy bonds, you need to give them interest. So if you want to borrow money, if the government, sorry, wants to borrow money from you, they have to pay you interest, and they have to entice you. And to do that, they have to increase the interest rate so that you would buy the government bond. Therefore, the yield rate will increase. And if that happens, then mortgages will compete with that. In other words, people who give out mortgages will have to increase their own interest rates because they are competing with government bonds. Why would someone lend money to someone who wants to buy a house and get 1% interest back if instead they can go and buy a government bond and get 3% interest or 4 or 5% interest? So then mortgages start to compete with the US Treasury yield, and therefore the mortgage interest rate will increase. And that could be the main reason why interest rates might increase. And that could even cause the Federal Reserve to increase interest rates, since that's what's happening anyway. So the base rate could increase overall. So that, in my opinion, could be the catalyst to cause the biggest decrease in house prices, an increase in interest rates. And those are my first 2 points, and I'll go through the other points a bit quicker. Point number 3 is there's a lot of social and political pressure. You've seen how Jeremy Corbyn's winning more support from the youth in the country. There are a lot of the homeless people. Homelessness is really increasing in the country, and it's not nice to see. And there's a lot of pressure on the government, and even the Tory party is speaking about reducing house prices somehow, getting more homes built, and that social and political pressure will somehow encourage the government and the house builders and whatever else needs to be done to somehow get house prices lower. Point number 4 is the extreme state of the economy. See, what we have now is a fragile economy. It's Imagine if you're at the edge of a cliff and you're walking right at the edge. You're at danger of falling off. But if you're further back, you're at less danger. What we have at the moment is a lot of government and private debt. We have very low interest rates, and this could cause big problems whereby something could go wrong, a black swan event could happen, something unexpected could happen, and that could have a domino effect on other things. So, the extreme state of the economy, this experimental economy, as some people call it, could lead to problems that we did not foresee. And therefore, this could cause problems in the housing market itself. Point number 5 is that a greater number of houses are being built, and this is due to the social pressure that there is. Point number 6 is Brexit, the lack of confidence. Brexit takes away confidence It also has an impact on the weakening of the pound. And when people are scared that the economy is weakening and they see business leaving, then they don't buy houses. Purely psychological there. Foreigners may feel unwelcome to invest in the country. Foreigners may leave, and there'll be more houses to buy there, so more supply there. Then there is the ending of the tax relief for buy to let investors on their mortgage interest. So if you borrow money from a bank and you have to pay the bank back interest as well as the amount that you owe them, you can't remove that from your tax. But buy to let investors are allowed to do that, or they have been allowed to do that. And they could remove the full amount from the tax that they pay the government, and that could be deducted from their tax. And the ex chancellor thought that was unfair, and he thought to bring the buy to let investors in line with everyone else or most other people, that there's a need to remove this tax relief. And it has been dropping away gradually by 25%. So it started in 2017, and where there was full tax relief. Now in 2018, in the tax year to 2019, it's going to be 50% that they will have to pay, and then they'll have to pay the full amount from April 2020. So that means it becomes more expensive for these buy to let investors or buyers to maintain their business. It could cost them thousands of pounds more every year. And considering the almost fanatical approach to credit that people have in this country, where they're in so much debt and they're willing to get these mortgages to earn money from um, rent that people pay for their houses, I think even a small change can be dangerous. And many people have pointed this out, that now landlords will have to pay more tax. They say, the landlords say, we're just going to increase the rent, but that's not going to happen because people can't afford to do that. So therefore, landlords will start selling the houses. If landlords start selling the houses, house prices start to go down. And then when house prices start to go down, others will start selling, and we have the cascade effect. Then, of course, at number 9, we have the Help to Buy. In the Help to Buy scheme, the government gives a 20% loan of the value of the house to the buyer. And in London, it's a 40% loan. So if you buy a house, for example, for crazy £1 million, let's say, actually, it's I think the limit is £600,000. So let's say you buy a house for £100,000. The government will lend you 40% of that. So they will lend you £40,000. The bank can lend you £55,000, and then you only have to pay 5%, which will be £5,000. So your deposit will be £5,000. In this scheme, you only pay 5% deposit. The government gives you 40% that you give to the bank as a bigger deposit. So you take it from the government, give it to the bank. Now, this loan had no interest that you needed to pay back to the government for the first 5 years of the loan. There was no interest at all. Now, in 2018, it will be the first year that interest will be introduced, because 5 years are up for the first Help to Buy buyers. The 5 years are now at an end. So now they have to start paying interest. Some people say this is like a time bomb because people will not be able to afford this. Consider the fact that inflation elsewhere can make it harder. So I was saying the economy is at an edge where people can't afford anymore, where people are in debt up to the limit. Oil prices. Imagine if oil prices go up. Imagine if prices elsewhere go up. Imagine if unemployment goes up. Then you fall off that cliff. See, if you're far away from the edge, you've got some way to go. But if you're right on the edge, you can easily fall off. And that's the problem this economy has. And point number 10, my final point, is that I think the cryptocurrencies will start to take up some of that money that people put into houses, because cryptocurrencies, unlike stocks and other commodities like gold and oil, we've seen ordinary people, especially the youth, putting money into cryptocurrencies. Now, I have to say, they are the more um, knowledgeable youth. Some of them, not all of them, but the early adopters were, who the ones who who were willing to take on risk and look into alternatives. And this is money of the internet, so the youth are going to be drawn towards it, unlike whatever the establishment gives them. And I think if house prices start to go down, people will say, well, where should we put this money? They could leave it in the bank. Some will put it into crypto. And I even think if there's a stock market crash, which there will be, we're due one, that money will eventually go into cryptocurrencies. Cryptocurrencies could fall in value because of interest rates going up. So therefore, there's less credit available, which is what caused the house prices to go up in the first place. The greater credit, there was more money put into the system by the central banks. Therefore, house prices went up, other asset prices went up, art prices went up. And if interest rates go up and all these bubbles start bursting, maybe cryptocurrencies could also start falling because of that. Not only because cryptocurrencies have already gone through a big bubble. And then after that happens, maybe then the money will start to go into cryptocurrencies. So crypto could go down more. And then later on, it will start to go up a lot faster while the stock market will still be falling. And the stock market can take 1.5, 2 years to reach a bottom, whereas house prices can take a number of years, 6, 7 years, maybe. Anyhow, those are my main points, and that's the argument I'm going to make for house prices going down. To sum it up, we are at extreme points. When things reach an extreme, they rebound. It's like when you press down upon a spring, eventually it will, there'll be a reaction there. You stretch an elastic band, it will react. So we have reached an edge and it has to rebound. And that's generally the gist of my argument. Now, I must say, it's not as if I'm looking forward to people losing their houses. It will be a very sad thing. I believe that we should have laws in place whereby houses are not seen as a speculative investment. So, the kind of things that they do in Germany, maybe, or we can have laws such as taxing people heavily or making multiple houses illegal to own, because we just haven't got enough houses and they shouldn't be seen as a speculative investment, capping house prices somehow. So we need to control this. Unfortunately, this hasn't happened. People have been sucked into this propaganda of buy a house. It's it's a great investment. It's your lifetime achievement. Everything you must work for is towards buying a house, and then you'll be happy when you're an old person. And that's really terrible because people will lose money, unfortunately, and a lot of very decent, hardworking people could suffer. So, if house prices go down, they'll be suffering. But if house prices don't go down, they're still suffering. It's a difficult issue. Some people have said maybe the best thing that could happen is if there's inflation, and then we could reduce house prices via inflation. So therefore people earn more, but the price of the house doesn't go down. We somehow manage to cap the price of the house, but increase people's wages. Therefore, those who have already got a house will not fall into negative equity, and those who don't have a house will be able to afford it. I don't know if that will happen. I think things will be stuck the way we are, and we will see a crash over the next few years. I must add one more thing, and that is the question of how did I come up with this number of 40%? And it's through looking at charts, looking at other factors, other figures, and coming up with the number itself. And I don't want to go into that at all because this recording is already very long. Thank you for listening.